There's a moment so faint, so easy to overlook that separates the traders who survive from the traders who vanish. Jesse Livermore called it the invisible clue. And once you learn to recognize it, every major market collapse suddenly looks predictable, almost inevitable. I've spent years studying that subtle signal, not in charts or indicators, but in the shifting psychology that Livermore believed ruled every market turn. And tonight, I want to take you inside that mental framework, the one he used to sidestep the crashes that destroyed everyone else around him. Before we go deeper, let me ask you something. Have you ever sensed the market changing before the charts confirmed it? Comment your experience below. Now, let me set the stage. When I study the markets, I don't start with data. I start with behavior. I start with the collective pulse of traders who think they're acting rationally, while unknowingly marching toward the same cliff that generations before them fell from. Livermore understood this better than anyone. His greatest trades weren't born from brilliance. They were born from listening to what the market was whispering when everyone else was too excited, too stressed, or too blind to hear. And here's the twist. The clue that warned him wasn't some secret pattern. It wasn't a mathematical formula. It wasn't a hidden indicator. It was the moment when price stopped behaving right. When the tape, as he called it, began to resist the crowd's enthusiasm. When buyers should have been able to push through resistance, but didn't. When sellers should have been crushed, but held their ground. When the market began acting off. Subtle, quiet, almost imperceptible. Livermore learned to watch for that change the same way a sailor watches for a shift in the wind. Most traders look for confirmation. Livermore looked for deviation. And that difference between the typical trader and Livermore's mindset is the difference between being caught inside a crash and being positioned perfectly outside of it. But let me take you deeper into the reason this invisible clue matters more today than it did a century ago. Modern markets move faster. Information spreads instantly. Everyone has tools, indicators, models, screens, news feeds. But the one thing no tool can measure, the one thing no algorithm can fully translate, is the emotional temperature of market participants. And that emotional shift is always the first sign. Before the news, before the panic, before the chart breaks, the mood changes, the tone changes, the pressure changes, something tightens or loosens, and you can feel it if you know how to pay attention. Livermore wasn't predicting crashes. He was observing pressure points. He was watching for the moment when the crowd's belief in a trend started to fracture quietly, invisibly, but powerfully. And here's a secret I've learned through my own trading journey. You can't see the invisible clue with your eyes. You see it with your discipline, with your humility, with your willingness to stop wanting to be right and instead let the market reveal what's actually happening. Tonight, that's exactly what we're going to uncover. How Livermore sensed the breakdown before it ever appeared in price action, and how you can train yourself to detect the same shift. But before we go there, we must first explore the deeper conflicted contradiction at the core of every major market turn, because Livermore believed the invisible clue always emerges from that tension. Every market crash begins with a paradox. The moment of peak confidence is always the moment of greatest danger. Before I dive in, let me ask you directly. Have you ever felt most certain about a trade right before it unraveled? Share it in the comments. Your story might reveal more than you think. Now, let's explore this conflict. When I look back at every major market collapse, 1987, 2000, 2008, 2020, and countless smaller ones, there's a recurring psychological structure beneath the surface. It's a tension that builds slowly, silently, like pressure beneath a fault line. On the surface, everything looks stable, optimistic, even exuberant. But underneath, something begins to shift. Not in the charts, but in the behavior of those who believe they are in control. Livermore understood this. He believed that markets don't crack under bad news, they crack under excessive certainty. And this is where the paradox lies. The higher the confidence, the more fragile the market becomes. It sounds absurd, doesn't it? You'd think confidence would stabilize things. You'd think widespread belief in a trend would strengthen it. But confidence encourages overextension, leverage, complacency. It seduces traders into abandoning caution, replacing respect for risk with the illusion of inevitability. The market becomes crowded with players who don't know they're holding the same belief at the same time. A belief that can only survive as long as the trend keeps rewarding them. And that's the paradox. Livermore watched for the contradiction between what traders felt and what the market was actually capable of sustaining. Let me give you an example of the paradox in its purest form. When everyone is certain the market can't fall, it's already halfway to falling. When everyone is convinced the bull run will last forever, the bear is already sharpening its claws. That tension between emotion and market physics is where the invisible clue hides. But here's the part most traders miss. The clue doesn't appear during panic. Panic is loud, obvious, and dramatic. Anyone can see it. The clue appears before panic, during optimism, during certainty, during the phase when traders stop asking questions because their profits silence their doubts. That silence, that lack of questioning's dangerous. Livermore used to say that markets speak only to the traders who stop cheering long enough to listen. You can't hear a crack forming if you're celebrating the climb. And that's why the paradox is so sinister. The crowd becomes loudest, most confident, and most united right before the trend breaks. Meanwhile, the market starts behaving strangely, subtly resisting the enthusiasm that once fueled it. Buyers push, but the price no longer surges. Breakouts fail more often than they succeed. Pullbacks become deeper, sharper, more persistent. Volume swells at the wrong moments. Momentum hesitates. None of these alone signal catastrophe, but together, they whisper that something is changing beneath the optimism. I've seen it firsthand. There's a moment where you stop trading the chart and start trading the crowd. Without realizing it, you become part of the collective delusion. You forget to question the assumption holding the entire trend together. Livermore's genius wasn't that he predicted crashes. He simply refused to join the crowd's confidence. He treated excessive optimism as a warning, not a comfort. He watched for the conflict between sentiment and behavior, between what traders believed and what the market no longer supported. That contradiction, quiet, invisible, but deadly, is what we're going to dig deeper into next. Because the paradox eventually leads to something far more dangerous, the psychological trap that blinds traders right before the fall. The most dangerous trap in the market isn't fear, it's the illusion that nothing is wrong. Before I take you inside this psychological snare, let me ask you, have you ever ignored a small warning sign because the trade was going well? Drop your story in the comments. You're not alone. This trap has claimed traders for over a century. Now, let's step into the core problem. There's a point in every bull market where success becomes anesthetic. Profits numb caution. Good trades disguise deteriorating conditions. And slowly, almost imperceptibly, traders stop analyzing and start assuming. That shift from questioning to assuming is the trap Livermore feared most. This psychological blind spot forms gradually. At first you're cautious, observant, disciplined. You track behavior, watch reactions, feel the pulse of the tape. Then you score a win. Then another. Then a series of trades that confirm your worldview and reward your confidence. Your brain rewires itself to expect continuation. You begin to equate recent performance with future certainty. The trap tightens whenever you say to yourself, the market should keep going. That single word should is the quiet beginning of disaster. Livermore called this the belief lag. It's the emotional delay between what the market is actually doing and what traders emotionally need it to keep doing. People don't react to new conditions. They react to the memory of yesterday's conditions. The tape shifts, but the trader doesn't. And by the time they finally update their belief, the trend has already turned. Here's the cruel part. The better the market has treated you, the more blind you become. Confidence morphs into entitlement. Entitlement hardens into stubbornness. Stubbornness anchors you to a view that the market has already abandoned. You stop hearing the warning signals. You stop noticing the hesitation in price. You dismiss unusual reactions as noise. You tell yourself the market is just cooling off. By the time the danger feels real, it's already too late. I've fallen into this trap myself. We all have. You watch price behave oddly, but you rationalize it. You see volume spike at strange moments, but you explain it away. You notice your positions stop behaving the way they did before, but you tell yourself it's temporary. You push away the discomfort because the trend has been so good to you, and you don't want the party to end. That's the core problem. Traders don't fail to see the clue. They refuse to interpret it. Livermore understood that humans aren't built for markets. We're built for patterns, especially patterns that reward us repeatedly. Our instinct is to cling to comfort, to continuity, to the familiar, and markets weaponize that instinct. They lull us with streaks of success, then shift behavior in a subtle way that only the unemotional observer can detect. That subtle shift, the mismatch between what traders expect and how price actually behaves, is where the invisible clue lives. It's the crack before the collapse. But instead of respecting it, most traders deny it. They rationalize. They double down. They widen stops. They trust the trend. And with every rationalization, they walk deeper into the trap. Livermore once remarked that the market warns you more often than it surprises you. The problem isn't the absence of clues. It's our inability to accept them. The psychological trap is not fear, greed, or impatience. It's the refusal to update our beliefs. When the tape stops confirming the story playing in our heads. And now that we've exposed the trap, it's time to bring in the person who understood it better than anyone, Jesse Livermore himself. Because the way he approached this trap wasn't intuitive, it was revolutionary. Livermore didn't just avoid the psychological trap, he turned it into his greatest weapon. Before I unpack how he did it, let me ask you something. If the market whispered a warning you didn't want to hear, would you listen? Tell me in the comments. Your answer reveals more about your trading future than any chart ever will. Now, let's step into Livermore's mind. If you study his writings, his losses, his victories, and the rare notes he left behind, a pattern emerges. He wasn't trying to predict the market. He was studying behavior, not just the behavior of price, but the behavior of traders. And most importantly, the behavior of the tape when it stopped cooperating with the emotional majority. Here's the philosophy he lived by: a market is never wrong. Opinions often are. That single sentence is the doorway into how he avoided the trap that consumes most traders. While others formed convictions, He formed observations. While others clung to narratives, he clung to reactions. He wasn't interested in what the market should be doing, watched what the market was doing, and when the crowd became euphoric, the trap tightened around them. Livermore shifted into a completely different mental mode. He treated euphoria as danger. He treated certainty as instability. He treated unusual behavior as signal, not noise. But the most critical piece, he viewed market behavior through a psychological lens, not a technical one. When a stock acted right, responding strongly to buying pressure, absorbing selling, respecting trend, momentum, he trusted it. When a stock acted wrong, hesitating, stalling, failing to break cleanly, absorbing buyers at the wrong price levels, he didn't argue with it. He didn't defend his opinion. He didn't rationalize. He simply stepped aside. Livermore understood that when price stops acting right, it's not just a technical phenomenon, it's a psychological fracture, a shift in the intentions, fears, or positioning of traders who were previously unified. And that psychological fracture always precedes the visible breakdown. Let me share the mindset shift that made Livermore unique. He believed the market telegraphed danger long before danger became obvious, but the signals were delivered quietly, only detectable to the trader willing to abandon ego. He wrote about this often. It is never the obvious that destroys a trader. It is the thing he refuses to believe, that refuses the unwillingness to accept that conditions have changed, does what he trained himself to eliminate. And how did he do that? By building a personal rule. He never argued with the tape, not when he was winning, not when the trend looked perfect, not when every expert said the opposite, not even when walking away felt painful. Livermore's discipline came from understanding a harsh truth. The market is not obligated to continue rewarding you simply because it rewarded you yesterday. So the moment it began acting strangely, hesitating where it once surged, rejecting levels it once accepted, punishing behavior it once rewarded, he paid attention. Most traders interpret unusual behavior as an inconvenience. Livermore interpreted it as an omen. And that's the heart of his philosophy. The invisible clue wasn't a signal he hunted, it was a behavior he respected. He believed the first breaking character was the market's quiet confession that something fundamental had changed. While others waited for confirmation, Livermore reacted to hesitation. While others trusted the trend, he trusted the tape. While others defended their beliefs, he defended his capital. This wasn't instinct. It was discipline sharpened by years of watching traders fail for the same reason. They wanted the market to behave a certain way, so they ignored when it didn't. Now that we've stepped into his mindset, it's time to see how this played out in reality. Because Livermore didn't just theorize about invisible clues, he recognized them, right before history's most devastating crashes. There's one moment, one specific sequence on the tape, where Livermore saw the invisible clue so clearly that it changed his entire posture toward the market, and it happened just weeks before the 1929 collapse. Before I walk you into that moment, tell me this. If you sensed a historic crash approaching, would you trust your instincts enough to act? Comment below yes or no. Now, let's travel back. I want you to picture New York in late summer of 1929. The streets are buzzing, but not with fear, with optimism, with celebration. The newspapers are printing fantasies about a permanent plateau of prosperity. Every portfolio manager, every broker, every taxi driver speaks the same language. Up. No one believes the music will ever stop. But Livermore wasn't celebrating. He felt something different. He sensed a shift, not in the headlines, not in the chatter, but in how the tape behaved. He noticed something subtle. Stocks that should have shot upward on good news didn't. Stocks that normally would have broken cleanly through resistance began hesitating. The market wasn't responding with power. It was responding with effort, heavy, sluggish, resistant. It was, in his words, tired. He later described the moment like watching a champion boxer who still looked strong but whose punches no longer carried the same force. The crowd saw strength, momentum, invincibility. Livermore saw fatigued on. Then the invisible clue appeared. One afternoon, a leading stock, one of the institutional favorites of the year, received a rush of buying. Under normal conditions, that surge should have exploded the price upward, but instead, it barely moved. A few ticks, nothing more, as if someone big was quietly absorbing all the buy-in, without letting the price advance. Livermore said that phenomenon chilled him more than a 1,000-point drop ever could. It wasn't weakness he saw, it was distribution. Controlled, patient, deliberate distribution from the hands of the informed into the hands of the enthusiastic. That was the clue. Not panic, not a headline, not a chart pattern. A behavioral shift hidden inside the tape. But what made Livermore exceptional wasn't spotting the clue, it was believing it, accepting it, acting on it while everyone else was celebrating. He didn't wait for validation. He didn't ask for confirmation. He didn't need to be right. He just knew the tape wasn't acting the way a healthy bull market should act. Something was off, and that meant danger, so he quietly shifted his posture. He reduced risk. He tested the short side. He observed reactions. He watched the market's character deteriorate slowly at first, then dramatically. Week after week, the clues piled up. Breakouts lacked follow-through. Rallies felt artificial, thin, temporary. Leading stocks cracked first, then recovered weakly. He wasn't watching price. He was watching behavior, and that difference is why he stood almost entirely alone, positioned on the right side of history while the world entered a financial meltdown. But here's what truly matters for you and me. Livermore didn't have news. He didn't have modern indicators. He didn't have computer models. He had a sense of behavior trained through pain, sharpened through experience, and trusted even when the entire world disagreed. This story isn't from a textbook, it's a blueprint, a living demonstration of how subtle the invisible clue can be, and how devastating ignorance of it becomes. Because the story doesn't end with Livermore spotting the clue. It ends with everyone else refusing to see it, until it was too late. Now that we've explored the historical moment, we need to dive into the emotional aftermath, a point where the trader's spirit is tested most, where denial becomes dangerous, and where Livermore's discipline is pushed to the edge. There's a moment, right before the truth becomes undeniable, when the market tests not your strategy but your courage. Let me ask you, if every trader around you swore you were wrong, would you still hold your conviction? Share your answer below. For me, this turning point always feels the same, a tightening in the chest. A quiet internal war between what I feel and what I'm seeing. Livermore faced that same pressure in 1929, even after recognizing the invisible clues. The world around him was euphoric. Headlines contradicted his observations. Friends dismissed his concerns. The tape was whispering danger, but the crowd was shouting prosperity. That emotional conflict is brutal. You start doubting yourself. You wonder whether you're misreading the market. You feel the weight of isolation pressing down on your judgment. Livermore described it as standing alone in a crowded room, certain the floor is cracking while everyone else keeps dancing. But the real break came when the market attempted one final rally, sharp, aggressive, loud, and yet it lacked life. That failure wasn't technical, it was psychological. It confirmed everything he feared, and that's when resolve hardened. The fear faded, replaced by clarity. The breakthrough didn't come from brilliance, it came from surrendering the need to be right. Before we go deeper, let me ask you, what's the hardest part of admitting a trend is over? Drop your thoughts below. Livermore's defining lesson emerged in the exact moment most traders fall apart. When the final rally failed in 1929, he didn't celebrate being right, he focused on being prepared. And that mindset crystallized into one of his sharpest rules. A principle that feels almost counterintuitive in the heat of euphoria. When a stock stops acting right, don't argue, step aside. Simple, ruthless, life-saving. This wasn't theory for him. It was a rule forged from years of ignoring early warnings, paying the price, then learning to respect subtle behavior more than loud trends. His breakthrough was accepting that markets don't reverse out of weakness, they reverse out of exhaustion. And exhaustion always shows up first in the tape, not the chart. The second part of his lesson was even harsher. Never expect the market to reward yesterday's behavior. If the tape changed character, his posture changed with it. No hesitation, no debate, no emotional negotiation. He believed the market reveals its intentions before the crowd realizes they've shifted, and the trader who waits for confirmation is already too late. But here's the real heart of his breakthrough. Livermore didn't protect himself by predicting crashes. He protected himself by obeying the clues that signaled when the tape no longer supported his positions. His edge wasn't foresight, it was flexibility. That's why he stood on the right side of disaster. Not because he knew the future, but because he refused to cling to the past. And now, with this breakthrough rule in mind, we need to translate it into the world you and I trade today. The markets may have evolved, but the behavioral cracks, the invisible clues, haven't changed at all. Before I break this down, let me ask you, do you think modern tools make traders more aware or more blind? Comment your take now. Here's the truth I've learned watching today's markets with Livermore's lens. The same psychological fractures he observed still appear, just faster, louder, and wrapped in technology. Algorithms amplify trends. Social media accelerates sentiment. Retail crowds unite instantly. But despite all that change, the core behavior of price remains surprisingly human. And that's where Livermore's insight becomes even more valuable. In today's markets, the invisible clue often shows up in moments like these. When a stock breaks out on news, but fades instantly. When indices push to new highs, but leaders lag behind. When momentum appears strong, but volume tells a quieter story. When dips get bought aggressively, yet the rebounds feel weaker each time. Those aren't random quirks, they're the same subtle signs Livermore saw on the tape, modernized. Behavior without follow-through. Strength without conviction. Demand without power. Modern traders fall into a trap he warned about, depending on indicators instead of reactions. Indicators lag, reactions don't. Livermore would have thrived today because he trusted behavior over tools. And here's the uncomfortable truth. Many traders now drown in data, missing the tiny deviations happening right in front of them. They wait for confirmation. Confirmation that comes long after the clue appeared. Livermore's method applies perfectly today. Respect character shifts. Trust, hesitation. Study reactions more than predictions, because even in 2025, the market still reveals its intentions quietly, before acting loudly. And now that we've framed the modern application, it's time for something intensely practical, a step-by-step way to apply the invisible clue in your own trading. Spotting the invisible clue isn't luck, it's a repeatable process, built on disciplined observation. Before I walk you through it, let me ask, what's the first sign you personally notice when a trade starts acting wrong? Share your tell below. Now let's break this down into something you can use immediately, no matter your style, time frame, or market. Step 1. Define acting right. You can't recognize deviation until you know the behavior you expect. For any position you take, outline what healthy reactions look like. Strong follow-through after breakouts, respect of key levels, consistent momentum on volume. When you define normal, abnormal becomes obvious. Step 2. Watch the reaction, not the move. Livermore didn't care about the news or the candle. He cared about what happened after. A move without follow-through is your first yellow flag. Hesitation where there should be strength is your second. Step 3. Track character changes, not price changes. Ask yourself daily, is this stock behaving the same way it did during the earlier stage of the trend? If the answer is no, pay attention. Character shifts precede trend shifts. Step 4. Reduce size the moment behavior weakens. Not when it breaks down. Not when your stop hits. When the behavior changes, size down without drama. It's your insurance policy. Step 5. Probe the opposite side. Livermore tested the short side when he sensed exhaustion. You can do the same. Small probes. Quick feedback. Not predictions. Experiments. Step 6. Let the market confirm your caution, not your conviction. If it's nothing, you can size back up. If it's real, you're already ahead of the crowd. Master these steps, and the invisible clue becomes visible, clear, actionable, and often life-saving. And now it's time for the final chapter, the cinematic close, where everything comes together.